discussing all about stocks on ET now. Thanks for staying with us. Now, like I promised in the previous segment, Hemang Jani of Sharekhan is with us in the studio to help us find the right investments in these markets. Hemang, thank you so much for joining us on All About Stocks. Now, we're familiar with Hemang on this show. He was here on our first episode where he recommended BHEL and Yes Bank. That was nearly 5 weeks ago. And when he did recommend BHEL, it was trading at 1,952. And he gave us a target of 2,596 for a year. That stock is down 200 rupees right now. So, Hemang, do you still stand by that recommendation? Do you still think BHEL is a good stock to buy?
Absolutely. I think one has to see this in the context of the overall market, because we've seen the market also correcting quite sharply ever since we did our first show. And yes, BHEL has corrected, but we think that the overall growth story and the comfort that we have in terms of the valuations being so attractive continues to be very good. So we think this is a great opportunity for those who have not participated in the stock so far.
The next recommendation you had made, this was 5 weeks ago, was Yes Bank. That point it was trading at 318. It's down 40 rupees now. That's about 12%. Would you still recommend buying that stock at this price?
Absolutely. We think that, Yes Bank is one of the best banks in terms of the overall growth potential. And we've seen the banking stocks actually correct in the last 2 to 3 weeks because, there's a fear of the higher non-performing assets. And the interest rates may remain a little firm for the next 2 or 3 months. But we think that given the fact that Yes Bank has an extremely good, strong balance sheet and overall growth expansion is going to be much superior, we think that this correction provides a great opportunity for investors who have not bought the stock so far.
All right, so those two recommendations, Yes Bank and BHEL, they're standing by both of those recommendations, and he said there's still buys in the market right now. It's still an opportunity for you and me to buy, especially if you're a long-term investor with a 3 to 4 year horizon. Let's move on now to the recommendations he wants to make this week, and the first of those is HDFC Limited. This is his growth recommendation. Take a look.
HDFC Limited, India's largest home loan provider, has grown since its inception in 1977 from a specialized mortgage company to a financial giant with forays into banking, insurance, and venture capital. And at the helm of this finance company is a management team that makes the company what it is. Chairman Deepak Parekh and CEO K.K. Mistry have steered the company through major economic storms and have consistently delivered superior profitability and growth. The company's annual net interest income has grown to 4,648 crores in FY11 from 2,845 crores in FY08. HDFC's total loan book as on 30th June 2011 stood at 1.24 lakh crore rupees, with non-performing loans comprising less than 1% of the entire portfolio. But with property prices soaring through the roof and the RBI hiking lending rates 11 times since March 2010, the housing market faces the risk of a slowdown in demand. This in turn will ebb the growth of lenders like HDFC.
Alright, that was HDFC Limited. This is a company that has a single product, which is home loans and loans that they give to real estate. So it's a large play on interest rates. So are you of the opinion right now that interest rates have peaked and that we're going to see banking come back up again?
Yes, you rightly said that this is a single product company, but we feel that the kind of positioning it has and the kind of cycles of different interest rate environments the company has gone through, we think that this company has been able to withstand these interest rate cycles extremely well and has been able to maintain the spreads at about 2.2 to 2.3% under different interest rate environments. And the sheer opportunity for the middle class and the salaried class people to buy homes and go for home loans is so big that HDFC being the premier company with a good, strong distribution and a great name would be in a better position to grab this opportunity. So we think that it looks quite attractive.
And you said it is a growth stock. So if I'm a retail investor, I get it now at this point. I'm holding on for 3 or 4 years. What sort of growth can I expect? What sort of returns are you expecting? What's your target on this stock?
We think that given the fact that company has been able to maintain a return on equity of more than 21%, and in fact year after year it's been able to improve the return on equity even when most of the other companies are not able to do it, overall growth that one can expect from here on over the next 3 to 4 years could be about 18 to 20%. Because we think that since the bank, HDFC, is growing at about 20%, similar growth would be reflected in the price performance.
All right. So HDFC Limited, that was Hemang's first recommendation. That was his growth recommendation. And you have it. That's his target as well. Moving on to his next recommendation, CESC. This is an introduction to the company. If you're not familiar with what it does and what business it's in, take a look at the stock and take a look at how it's been performing over the last year.
Kolkata-based CESC is a power generation company and is the sole supplier of electricity in Kolkata and Howrah. CESC is the flagship company of the R.P. Sanjeev Goenka Group and has been around since 1899. In fact, it's one of the very few privately held public utilities companies. CESC has 2 new thermal power projects in the offing, which are expected to double its power generation capacity in the next few years. Of the 2 projects, the one in Haldia is expected to be operational by 2014. The other one in Chandrapur may see a delay in its commissioning on the back of a severe shortfall in coal supply. For FY11, CESC clocked in a net profit of 278.3 crores, a significant jump from FY09, when the company's net profit stood at 77.5 crores. Its retail arm Spencer's has been a dampener on the company's earnings for the last couple of years. But its fortunes are turning around now, and initial signs of recovery are already visible. The company is planning a sharp tariff hike of 26% in this financial year, which is of course subject to regulatory approvals. The stock has seen a 17% dip in the last 52 weeks, but analysts remain positive and continue to have a buy call on CESC.
All right, so that was CESC. The big risk here, like we heard on that story, is the risk of coal availability in India, which is something that this company is dependent on. How badly do you think that will affect business for CESC?
Well, CESC has been able to tie up 50% of its requirements through various coal manufacturers, and for the rest of the coal requirement, they have their own captive mines. So we don't think this would be a big handicap for the company.
Okay, and your expectations of how this company will do in the future, what are your targets for it, and what sort of growth do you expect from this stock?
We have set a target of about 410 for the stock over the next 1 year. And we feel that given the fact that the company is steadily growing and adding free cash flow to its books for the past 2-3 years, and because of the steady expansion in its capacity, the overall growth is going to be quite strong. And retail business, where the company had a bit of a problem because it was a drag on the balance sheet because it was making losses, we think that the company has stabilized operations, and this would be a big trigger for the stock, because once we have FDI into retail being announced, which may happen over the next few months, this could provide a big trigger to the stock.
All right, to that Spencer's arm that the company has. The other thing that's worrying about the stock is there are no big bids that have come in for ultra mega power projects from this particular company. They have stayed within Eastern India so far. Do you think that the trigger for the next level, for this company to move to the next level in power generation and distribution, will be to bid for an ultra mega project, maybe to move closer towards Western India where there's a real deficit for power, where the real businesses? Do you think they're going to need to spread to the rest of India? Where is that growth going to come from?
I think looking at the current positioning that they have, there is enough growth potential even in the Eastern India where they are currently focusing on, and they are steadily expanding that. We think that there is enough potential even in that region. So at the moment, there are no indications from management about their plans to move into other parts, and we are quite comfortable with their growth plans in that region.
All right, 2 recommendations from Hemang Jani. Remember, as a recap, we talked about BHEL and Yes Bank. Those stocks have corrected since the last time he was here, but he said it still makes sense to buy those stocks. It's still an opportunity for the long term. And he also recommended today, adding to that portfolio, HDFC and CESC as stocks that we should have in our portfolio. We're going to be tracking those investments also on this show, remember, and as our guests come back, we're going to ask them about the recommendations they made on this show. If you have questions for Hemang, you can write to us on the email ID at the bottom of your screen. Coming up on the other side, we're going to answer some of the questions you sent in during the week. Should you be holding on to Idea Cellular? Find out on the other side of it.